Robert Gardner. He joins us now from the lender's headquarters in Swindon. Mr. Gardner, good morning to you. So is this rise something of a blip, or do you think it actually marks an upward trend in house prices, albeit very slow?
Well, this is the first rise in annual house prices for 7 months, and given that's taking place against the backdrop of a very difficult economic environment, it is encouraging that the housing market seems to be fairly resilient. However, I don't think we should overblow it. The increase is very small. It's only 0.8% compared to October last year, and to be honest, it doesn't really change the picture of a fairly stagnant market. Prices have basically been moving sideways for the last 12 to 18 months, and this latest set of data really doesn't change that. Demand in the housing market remains very weak due to weak labour market conditions, but supply also remains very weak. We haven't had a lot of building. We see weak demand, weak supply, and house prices basically treading water as a result.
9:30, of course, is when we get the GDP figures out for the United Kingdom. How much does housing contribute to that figure, Robert?
Well, in terms of house prices, obviously that doesn't feed into it. What would feed into it would be construction activity, because it's the output data that we're expecting, and we haven't seen a lot of house building over the last couple of years. The pace of house building in the UK has been very weak, and no doubt we'll see that continued when we get the data out this morning. If you look at the pattern of the housing market, though, as I say, it's a picture of weak demand and weak supply that really has been evident in the market for quite some time now, and it's probably going to be a picture that's with us for some time to come, given how weak the economy is and how weak labour market conditions are too.
And is that contraction of supply something that really is actually helping to push up those house prices in the past month?
Yes, I think it is the case that the lack of building that we've had has contributed to the fact that it is not oversupply in the market, even though demand for housing has remained very restrained. The other thing that's helped as well has been the very low level of interest rates. Not only has that supported demand, but it's meant that we haven't had lots of forced selling either, and as a result that's helped to keep a lot of properties from coming onto the market, and it helped to keep demand and supply relatively well matched, and helped to put a floor under house prices over what's been still a very difficult economic situation, especially for households.
How much of a problem is lending? The banks are ultra cautious, and if you're a first-time buyer and you haven't got, what, 10–20% of the asking price, might as well forget it, right?
It's definitely the case that the supply of credit has been much tighter compared to the pre-crisis period. Nevertheless, if you look over the last 6 months or so, what you've seen is, even for the mortgage rates on offer for quite high LTV mortgages have been coming down. They're not high by historic standards. I think the thing that's really kept demand for homes back has been the weakness in the labour market. The fact that unemployment has started rising again. We saw in the 3 months to August, unemployment rate moved up to 8.1%. Wage growth is very subdued. It's not keeping up with the pace of inflation. Consumer confidence is very fragile. On our index, we've seen confidence down at levels prevailing even during the depths of the recession. All those things, I think, explain why people are holding back from the market. We need the labour market to improve before we see demand for homes to pick up, and unfortunately that's probably some way away yet.
We'll leave it there. Robert Gardner, Chief Economist at Nationwide Building Society, I'm grateful to you. Thanks very much indeed for joining us on Bloomberg today.